3,100 is punchy to the downside. How do we get there?
Hey, Jonathan, this is when we look at the market right now, it looks like the very near term has some weakness, about 8% within a range of 3,400 plus or minus 300. If you get into 2021, depending on the electoral outcome, depending on fiscal spending and a number of other factors, it could go as high, as I said, to 3,700. We think down before up, and we've been playing a tactical game on the market for 3 years. Remember, we were inflation adjusted about 3,000 on the S&P at the January of 2018. We've really been trading in a widening amplitude range for the last several years. And honestly, we have to be very careful to take long-term views in this kind of a market with an elevated VIX volatility where it is.
That seems sensible right now, given the amount of uncertainty on the horizon. Barry, let's talk about what you're keying off, what you're looking at. How important are real yields right now?
Well, there's several things that worry us. You mentioned real yields, and that's going to affect the PE, particularly on long-duration growth stocks. It was the suppression of the real yield from plus 1% at the Powell pivot in December 2018 to minus 1% just recently that drove the PE ratio of the S&P higher. At low inflation, using equity risk premium, you can justify very high valuations at a negative real yield. So that was the main factor. And right now, we're seeing some signs there might be some disappointment in the near term on inflation. I mean, you're looking at the pipeline, inflation indicators, Michigan sentiment, near-term inflation, the Purchasing Managers Index, non-manufacturing prices paid. If you look at some of the other factors that we look at, like New York Fed underlying inflation gauge, advanced 15 months aligning with the core CPI, I think we're going to have some pressure on inflation. And that would, unless the nominal 10-year drops, which I don't think is bullish, that's a sign of weak growth. If the nominal 10 doesn't drop, then you're going to have a higher real yield and a lower price-to-earnings ratio. So that is a concern of ours, beyond just the whole fiscal, virus, and political issues that are going on right now.
So, Barry, this conversation is really, really important, what you're describing right now with real yields. As you point out, the key variable right now, inflation expectations, because nominal yields really aren't doing much at all to the downside, Barry. So my question to you is as follows. Most people would assume if the outlook for growth rolled over a little bit, then you're willing to pay up for growth in the equity market. But if I'm right in interpreting what you're saying, if inflation expectations start to roll over and real yields start to move the other way because of that, that damages growth equities too. So your outlook for growth right now, Barry, on either side is not pretty, is it?
No, it's not. And you know, when you have a long-duration market, a high PE market, and an elevated VIX, it's kind of a dangerous combination. You're out there on the curve on volatility, and you're out there on the curve on almost convexity-like. If you look at the real yield, you're out there on the curve with your price-to-earnings ratio, your earnings yield. So we think the market's fraught with risk, high volatility, and into the autumn where I don't see any fiscal stimulus. I think they're playing hardball, and Speaker Pelosi's kind of got a wish list there that's largely political. And the White House is taking a high risk, I think, by assuming that 3 more weeks of economic momentum to get through the election. They can work on it after the election. But clearly, we're looking at the quantitative side of the market, and it's that real yield that's got our eye.
Where'd you hide, Barry?
Well, you know, it's interesting. If you, it's been very much, Jonathan, a market of, a stock market that's really a market of stocks. The FanMag, the Facebook, Amazon, Netflix, Microsoft, Apple, Google, these stocks have dominated, and they're long-duration growth assets, of course. So, but if you equal weight the S&P cyclicals relative to defensives, so equal weight technology, consumer discretionary, energy, financials, materials, and industrials relative to equal-weighted staples, utilities, and healthcare. So it's cyclical relative to defensive. It just bounced off at the recent high of 3580 on September 2nd on the S&P. It just bounced off the resistance level that's held for 20 years. So our thought process is go with defensives in the near term, the staples, utilities, and healthcare, because the market's probably going to sell off to about 3,100 by the end of autumn as you get past the election.